Hey y'all, this is Carter, and today I'm going to be filming this lecture on valuation multiples and their meaning. And I'm doing this in case someone in my analyst group ever wants to watch this, or just to go through these concepts and learn them better myself, and also hopefully get better public speaking. So hopefully I'm not stumbling around too much during this. But here we go. So what do multiples tell us about a stock? Here are some common multiples: EV to EBITDA, EV to free cash flow, price to earnings. But I think the typical person, if they see, company is priced to earnings of 20 and this one is priced to earnings of 10, you might be like, oh yeah, price to earnings of 10, that's very underrated. The market doesn't think it's going to do so well, but maybe it will, underrated. But like, what is it really telling us about the market's, expectations for, a company's future outlook? So yeah, valuation multiples at a high level give us a rough estimate of the expectations that the market is baking into a company's share price. But more specifically, regarding a company's operations, it's the market's expectations for a company's future growth, cost of capital, and incremental return on invested capital. So let's look at growth rate here. So here we have company A, company B. Company A is free cash flow of 100 and company B is free cash flow of 50. Yet the market is valuing them both at an enterprise value of 1,000. And this is pretty strange, right? Equity investors derive all value from a company's free cash flows in the form of dividends or buybacks. So why is company B trading at a premium when compared with company A? Well, the simple answer there is growth. The market must think that company B is going to exceed company A in growth rate, such so that they will eventually have the same enterprise value if we're looking at cash flows into perpetuity. So that's why company B has a multiple, EV to free cash flow, that's double company A. You could say, yeah, if a company's multiple is higher than another company's multiple, the market thinks that that company's free cash flows are going to grow at a faster rate. Well, that's not quite it, as we'll see. But yeah, expected growth in free cash flows, that's one of the things that a multiple can tell you. But we also have to look at incremental return on invested capital and WACC. For a company to grow its free cash flows, it has to make incremental investments, either investments in its working capital, such as inventory, or growth CapEx. So CapEx above its current D&A, like a new factory. And we can see, not all incremental investments are value additive. Some of them are actually value destructive. And we can tell that by looking at the relationship between incremental return on invested capital and WACC. So, just to explain incremental return on invested capital, I'm sure we all know ROIC, return on invested capital, is just NOPAT divided by invested capital. But incremental return on invested capital, which is more important here, is, if we make an incremental investment for a company, how much does NOPAT change? So it's more so looking at like, how is NOPAT changing in regard to a specific investment? So it can really tell us and pinpoint if an investment is value additive or value destructive. So let's keep looking at ROIC and WACC. So let's say, for instance, a company A wants to increase their free cash flows. They want to grow, just like every company, and they invest $1 back into its business, and its cost of capital is 5%. And its incremental return on this invested capital, this $1, is 6 cents. So 6 cent free cash flow gain, or NOPAT gain. We're kind of using free cash flow and NOPAT, as proxies for each other here, which isn't quite accurate, but for the sake of the exercise, we're going to do it. So in this case, ROIC is 6%, WACC is 5%, and that means that the business has created value through this growth. And we can kind of think of ROIC as IRR in this case. When you compare IRR to WACC, if IRR is above WACC, it's an NPV positive investment. We should pursue it. If ROIC or IRR is below WACC, that's an NPV negative investment, and we shouldn't do that. But in this case, ROIC is above WACC, so this is value creation through incremental investments. And because free cash flow grew by 6 cents, but it only cost the business 5 cents to do it. And in this example, WACC is 5%, ROIC is 5%, or incremental ROIC is 5%. And this is doing nothing to the overall value of the company. It's just preserving value. And just to be clear, when I say value, creating value, that just means the present value of a company's future free cash flows is going up. So ROIC equals WACC, no value is created or destroyed because free cash flow grew by 5 cents, but it cost the business 5 cents to do it because of the cost of capital. And then lastly, we have an example where company has WACC of 5% and return on invested capital is only 4 cents. And this is really bad. A company doesn't want to pursue investments that are NPV negative. If a company has no more potential investments that are NPV positive, it should just return back that cash to shareholders through either a dividend or a share buyback. It should never, continue to invest in NPV negative investments. So right here, free cash flow grew by 4 cents, but it cost the business 5 cents to do it. So in this case, you might think, oh, it's going to have a higher multiple because growth is good, but in reality, growth is bad here because it's destroying value at a faster rate. A company like this, if they keep investing in the same NPV negative investment, the faster they grow, the more value they destroy effectively. So now we're going to do some math here to figure out the exact formula we can use to show that a multiple is a function of ROIC, WACC, and growth rate. So first, let's start out with just a classic perpetuity. We say EV equals free cash flow divided by WACC, assuming no long-term growth. So this is just I tell you, hey, I'm going to give you $100 every year for infinite amount of time. It's a perpetuity. Then we can figure out how much this perpetuity is worth by just dividing free cash flow, 100, by WACC, 10%. So 100 divided by 0.1 equals 1,000. And, free cash flow is 100, EV is 1,000. So this gives us an implied EV to free cash flow multiple of 10x. And in case you're wondering, why is this perpetuity worth 1,000? How does this math work? It's really just an infinite series. In year 1, that 100 is worth 100. In year 2, it'd be worth 91 because of the discount, 83 the second year, just because it keeps getting discounted back at a higher rate. Ultimately, it would converge at 1,000. And every year is free cash flow. 1,000 years from now, that $100 I give you is effectively worth nothing. So that's why it's converging at 1,000, and that's why this works. But in reality, companies want to grow. A company's never just going to be yeah, I don't want to grow anymore. I'm just, going to give you this much every year. Every company wants to grow. So in reality, this is the way to look at it. EV equals free cash flow divided by WACC minus growth, assuming constant growth, which isn't always realistic, but, for the case of this, we're going to assume that. So in this case, free cash flow is 100, WACC is 10%, and growth rate is 2%. We can through here, instead of 100 divided by 0.1, it's 100 divided by 0.08 because of this growth rate. So the implied EV to free cash flow multiple here is 12.5. So now we're going to do some formula derivation. We're going to derive a formula by starting out with first principles. This formula, EV equals free cash flows divided by WACC minus G. So from here, let's define what free cash flow is. Free cash flow equals NOPAT times 1 minus the investment rate. And this is really, if you've done a DCF before, you know this, even though this might seem a bit abstract to you. Investment rate is just the percentage of NOPAT that is reinvested back into the business. So if I have NOPAT of 100, and I'm I'm going to invest 50 of that back into my business, either through growth CapEx or investments in working capital, then that means my investment rate is 50%. And we're going to see why this is important. So growth rate equals return on invested capital times investment rate. And here's why. So if we have year 0 and company A has NOPAT of 100 and it invests half of that back into incremental investments. So it invests 50 of the $100 and it has an investment rate of 50. And for every incremental investment, this company A has an incremental return on invested capital of 20%. That means that the company invested $50 incremental investments, and it has a return on those incremental investments of 20%. So this effectively means that NOPAT will grow by 10% through this formula, and now NOPAT will be 110. This makes sense. And now let's keep, deriving. So investment rate equals growth divided by ROIC. This is just some simple algebra, changing the variables around. So this should make sense. Theoretically, how this works is investment rate equals growth divided by ROIC. So if investment rate is 50%, then and growth is 50% and ROIC is 100%, that makes sense, right? If ROIC is 100%, growth should just be the same as investment rate. Sorry if you're not following along. Just know we're doing some algebra to flip this around. It doesn't really matter. So now we can plug all this back in, since we said here that free cash flow equals NOPAT times 1 minus the investment rate. We can just plug back in what we said investment rate is through this algebra, and now we have this formula. Free cash flow equals NOPAT times 1 minus growth divided by ROIC. And from there, we can do value. So we plug in free cash flow into this formula up here. Sorry, this does look a bit confusing, but it'll look easier in a second. So this is value right here, this formula. And as you can see, it's a function of growth, ROIC, and WACC. And just to be clear, every time I say ROIC, I mean incremental ROIC. So yeah, this is the value of a business, assuming constant ROIC and growth and WACC, which is definitely not realistic. But for the sake of this, academic practice, it is. So here's the multiple here. EV divided by NOPAT. And just to be clear, you can do this by any unlevered metric, EBITDA, free cash flow, but because it's ROIC and that's like NOPAT, it's just easiest to do EV over NOPAT. And this is the formula it gives you. And here's it written out. So this looks a lot easier. EV divided by NOPAT equals 1 minus growth divided by incremental ROIC divided by WACC minus G. So, this is the formula, this is the holy grail, this is what we've been looking for, right? This is great. And yeah, this shows you a multiple is a function of growth, return on invested capital, and WACC. And I'm going to explain now how these variables kind of relate to each other and how it is either creating value or decreasing value. So here's the golden rule here. Increased growth does create value. The present value of free cash flows increases if and only if incremental ROIC is above the company's WACC. This is very important. And here is the corollary to this. If a company's WACC is higher than its incremental ROIC, so basically its discount rate is higher than its IRR, then the faster the company grows, the faster it destroys value. So this corollary is basically showing that growth works in both ways. Yeah, typically good businesses have return on invested capital, incremental return on invested capital above WACC, so growth is good. But not always. This is not always the case. Now we're going to look at some examples so we can really understand the relationship between these three variables. So let's say we have a company with ROIC above WACC, assuming 12% ROIC, incremental ROIC, and 10% WACC. Well, now we can see these three. 2% growth implies EV to NOPAT of 10.4%. 4% growth, 11.1x. Sorry, 10.4x. 4% growth implies this multiple, 11.1x. 6% growth, 12.5x. So this shows the first formula. ROIC is above WACC, so growth is good. It's increasing the multiple. And here we go. ROIC below WACC. This is bad, not good. This is destroying value. And as you can see, which is very interesting that I didn't know before I really studied the relationships between these variables, that growth can actually be bad. Sometimes a company doesn't realize and they're like, oh yeah, we're growing, and investors are like, let's go, this is great. But it turns out this is bad if ROIC is below WACC, incremental ROIC. This is not good. As you can see, a company is willing to pay a premium on a company that is not growing in this stage. This is not good at all. And then this is also very interesting. When ROIC is equal to WACC, it doesn't matter what the growth is. EV to NOPAT is always going to be the exact same. So if a company is, making an investment that increases its, NOPAT by $10, but it's costing them $10 for that capital, then it's not creating or destroying value. So it's kind of just like either way, it doesn't really matter. So here's some weaknesses to this. In reality, incremental ROIC and growth rate are not constant for a company over time. There's a lot of academic theory that talks about incremental ROIC and discount rate. A pretty popular theory is that a company will have a competitive advantage period, which means a period in which they are such a good company and so few, emerging competitors have entered the market that they will have a sustainable incremental ROIC above their WACC. So this is great. They're just, creating value all day. It's a wonderful time period, competitive advantage period. And then theory states that eventually this competitive advantage will be competed away by other, competitors. If like some entrepreneur sees that one industry is really good incremental ROIC above WACC, they're probably going to enter that industry, and then margins will decrease, and ROIC is just going to go down and eventually converge with WACC. So as you can see, incremental ROIC, WACC, growth rate, they're changing all the time. So this isn't exactly realistic, but it is a really good way to show what a multiple really means. When I first started looking at multiples, I was just like, oh, market thinks it's going to grow more. That's good, right? Tech companies have really high multiples because they're going to grow more. Yeah, that is true. That is why tech companies typically have high multiples, but it's not always the case. There's some low growth companies that have really good incremental ROIC, and as a result have pretty high multiples. People are willing to pay, a lot for them. So I'm not going to say this method is like, can just like hack valuation, but it is a really good way to quickly analyze the market's expectations for a particular company. I mean, really, what are we trying to do when we're doing an investment? We're trying to look at the market's expectations and see if that company will outperform those expectations or do worse than those expectations. And from that, we can come up with a buy, sell, or hold decision. So, thank you for listening to me talk in this video. It was really fun, and I hope you understand this better. Yeah, thank you.